Hi, everyone. Welcome to Unconfirmed, the show that reveals how the marquee names in crypto are reacting to the week's top headlines and gets the inside scoop on what they see on the horizon. I'm your host, Laura Shin, a journalist with over 2 decades of experience. I started covering crypto 5 years ago, and as a senior editor at Forbes, was the first mainstream media reporter to cover cryptocurrency full-time. Unchained and Unconfirmed are now published as videos. If you're not yet subscribed to the Unchained YouTube channel, head to youtube.com/c/Unchained podcast and subscribe today. Crypto.com, the crypto super app that lets you buy, earn, and spend crypto. Earn up to 8.5% per year on your Bitcoin. Download the Crypto.com app now. Today's guest is James Slazas, founder and CEO of LiquidStake and DARMA Capital. Welcome, James.
Hi there. Great to be with you.
The big news this week was Ethereum 2.0's Beacon Chain launching, which happened on Tuesday, December 1st. As exciting as this was, it presents a little bit of a conundrum for people who may want to participate. How would you describe that challenge, and how does LiquidStake propose to solve it?
I guess the difficulty or the challenge is that as somebody stakes the Ether, they are unable to remove it for the next, and we're not, it's undetermined amount of time, but let's say it's 18 to 36 months. So you don't have any access to that, but you are earning rewards as you're staking. And so what we did at DARMA Capital and LiquidStake is basically just come up with an offering that enables people to stake through what I would just call world-class validating service providers. And then we provide loans or a swap contract that enables them to then gain liquidity so they can continue to use that asset, let's say for, DeFi projects, or call it pay your rent. Anything, it just basically means that they're able to have their, to be able to stake and then be able to have liquidity.
And so walk me through how it works from the perspective of a customer who comes to LiquidStake.
So, and so we have two different types of customers. Right? The first, LiquidStake, would be an individual, and they want to stake. They may or may not have chosen a service provider, and a service provider is a team that's created the software so that you can actually validate blocks, right? And so they would go into our website, go through an AML KYC process. After they're approved, then they would either choose this validating service provider. We've partnered with Bison Trails, Consensus, and Figment, and so they would send the Ether in. We would stake it through that validating service provider, and we would hold those keys. I'll explain why we do that. And we would then go and stake the Ether go into the deposit contract, onto the Beacon chain. And as those, so then it's DARMA or LiquidStake basically holding those that Ether and being responsible for all the validating of the blocks. And then from there, they would go to a dashboard that would say, here's how much your assets are worth. And they would be able to then gain a loan from that.
And how much can they take out?
35%. And basically over time, as the market moves, there'll either be a margin call, or as the asset grows in value, let's say either from price or from additional accrual of rewards, then they can take out additional monies if they want.
And so for that instance of when the dollar value of someone's stake drops below the amount that they've borrowed, what happens?
So that's the difficult part here. So as I was alluding to, that we hold the keys to the Ether. So we have to be able to do that so that we can actually control this staked Ether in the deposit contract. If the market had dropped and we had sent out different margin call requests, the user wasn't unable to supply any more collateral, it would go through a liquidation. And liquidation for this type of contract is a little bit different, and it does sound severe. And it's basically that if the market goes down to that level, we have an immediate liquidation event, and the reason for that is that the ether is all locked up. There isn't a trading market for this, and so once it touches that, goes down to that level, what we're having to do is we're having to basically journal over those assets to our fund, meaning that we're purchasing them. And then we're in the open market, potentially selling freely traded ether. So it's a little bit different than if you had a freely traded asset that goes down to the liquidation level. Then they're able to work it out a little bit easier. Like you would see different prints on an exchange or over the counter.
So their entire stake is liquidated.
The amount of whatever their loan is.
Oh,
It
okay.
basically it's not that they lose their assets. I just when I say severe, I just mean that it happens immediately at that price level. But it's obviously we're only entitled to get paid back the loan amount. So it would just be that. The rest obviously would get delivered back to them once we reach phase 1.5, or basically ether is able to be removed from the deposit contract.
Okay. So Dharma Capital gets the ETH that is liquidated.
Right. So we
And
we we purchased that. We purchased that during that liquidation process.
and is that the main way that Liquid Stake and Dharma Capital are making money from this, or do you also charge fees in addition?
Yeah, that's actually we don't expect to make much money off of that, and I mean on both sides of it. It's not we're not looking to have all these great liquidation events. I would say our perspective is that as ETH2 gets validated, that's going to be very positive for Ethereum. It's going to continue to grow the ecosystem, and I would assume that that would mean you'd have a market appreciation, right? So rather than thinking that we're going to have a severe, downturn, I think that this should actually, as this gets validated more and more, it will increase the value. For us, we just charge an interest rate. So currently we're charging 13.5%, and the difference in how we're lending the money is that typical lenders in the market receive assets, they give out a loan, and they take those assets then and lend them out to somebody else, right? And then they earn a rate off of that. For us, obviously, because these assets are all locked up into the contract, can't be lent out. We're not doing that other side of it. So rehypothecation isn't occurring. And essentially what that just means is, one, we don't have that other counterparty risk, but also we don't gain the benefits of being able to charge, earn a reward, interest rate off of that.
And how do you determine the price of ETH to both make a loan as well as to liquidate?
So obviously the biggest driver is the cash market of Ether. And what we do is we take a discount to that cash market. So we use a 15% discount to that. And what that is basically because the ether isn't tradable, and whoever does buy that has to hold it until phase 1.5. There's these encumbrances on it, right? And so currently that's what we do is we take the spot, discount it by 15%, and then that's the value of the ether, staked ether collateral.
And how are you determining what the spot price is?
So what we do is we take the midpoint of four different exchanges. So we take Binance, Coinbase, Gemini, and Kraken, and we use that the midpoint price as the value for what Ether's trading at.
And what if there's like a flash crash or something on one of those exchanges?
If there is a flash crash, I mean, every long tail event, it's part of what we have to look at. I mean, if all four of those exchanges all did go down to a low level we would have to liquidate. I would say inherently in our structure, because we have that immediate liquidation, if it were to go down severely, let's just say 99%, somebody's already been liquidated much earlier than that, right? They've been liquidated at that 15 point decline. So it is a risk actually that we take on for doing that. But obviously, if we saw something where it was like this in a few seconds and basically comes up, that's something that we'll have to look at as what goes on in the market.
So in a moment, we're going to discuss the institutional offering, but first, a quick word from the sponsors who make this show possible. Crypto.com, the crypto super app that lets you buy, earn, and spend crypto, all in one place. Earn up to 8.5% per year on your BTC. Download the Crypto.com app now to see the interest rates you could be earning on BTC and more than 20 other coins. Once in the app, you can apply for the Crypto.com Metal Card, which pays you up to 8% cash back instantly. Reserve yours now in the Crypto.com app. Back to my conversation with James Slazas. In addition to retail customers, you are also serving institutional clients. What types of institutions can stake using LiquidStake and DARMA Capital?
An institution under the CFTC guidelines is called an ECP, an eligible contract participant. And it basically equates to a similar idea of what accredited investors are. And the institutions, so from a jurisdiction standpoint, obviously, as long as it's not a restricted jurisdiction, any institution would be able to participate. DARMA goes through the process of reporting to the regulators. We use the CME's swap data repository as a way that we supply all of that data to the CFTC. And I would say that the differences of why one might use LiquidStake versus DARMA Capital is that we offer to the institutions a swap contract. And so swaps have been around for a number of years, and they have good clarity on regulatory and tax treatment.
Can you define what a total return swap is?
A total return swap is essentially just you have two counterparties. One's paying a return, and the other one is paying let's call it a competing return, and the net of those two makes the payment flows. So in this scenario, you would have that someone is staking their ether, let's say paying an interest rate on a loan amount. So that's their pay side. From the DARMA Capital side, we're paying out the return of the ether staked. And so what we do is essentially just have that contract, those two payments net out each other. And we obviously assume that there'll be a larger amount of payment out of the rewards that are earned from staking.
And you mentioned that there's more tax and regulatory clarity for these total return swaps. Can you describe that?
Sure. So the obviously staking and rewards is a very new topic for Treasury, IRS, and so there's a lot of different groups within the community. I would say the Proof of Stake Association, POSA, has been leading the charge of being able to help define that. And today, as you stake, it isn't actually clear that if you move from Ether1 to Ether2, is that a taxable event, right? And so you can just imagine people owning Ether at $1. That's a huge impact if that becomes a taxable event. Additionally, when are rewards treated as income, or are they treated as income even? So is it as you earn them the next taxable year, or when you dispose of them? Again, there isn't clarity today, and so that was really the genesis from the institutional side of why we came up with the swaps. It was basically to say we can take that on. Um, and for DARMA Capital, we're based in Puerto Rico, so we actually don't have a capital gains tax, and so we're able to take on that side of the risk, and then we provide that that format to the institution.
And why did you decide on USDC as the stablecoin that your loans will be denominated in?
And I would say today it is USDC. We're definitely looking at other ways of providing the financing. For us, it's really been a lot from a regulatory perspective. Everything that drives us is first, what's the regulatory clarity, and then we start to look at the asset itself. So USDC, we felt very comfortable. I would just say that it hasn't been clear, and with Tether, so even though it has a larger market cap and maybe used more, it was easier for us to do that with our funding groups.
And so, what other stablecoins are you looking at adding?
Potentially, there may be something with MakerDAO and DAI. I would also say, given call it the Stable Act and things that are going on there, I assume we'll see a lot more banks being involved in the stablecoin market. We actually have an initiative that is enabling banks to do this that we'll be bringing online, and so I think that you'll have those kinds of stable coins being issued more from federally chartered institutions versus people spinning up a different kind of stable, just a stable coin, group.
Yeah, and just to be clear for listeners, the Stable Act was just proposed by Congresswoman Rashida Tlaib. And yes, it would put a lot of different requirements on stablecoin issuers, but it's just a bill, it's just a proposal at this point. Nothing's been passed. Aside from liquid stake and other centralized solutions, there are also decentralized ways for people to get a loan on their staked ETH2. What are the pros and cons of a centralized solution over a decentralized one?
So and we looked at how to solve this, and obviously we were looking at this well before the Genesis block, and so it was essentially how do we ensure that we reach that 259,000 ether to launch Genesis, right? And so we looked at this and saying, okay, we know that the time period is going to be a year and a half, maybe it's 3 years. So it's a shortened, in my mind, it would be a shortened trade. And how to just help facilitate people to get in. And that's where we just said, here's a centralized solution. It enables people to be able to stake early, and we can, and can go forward. That centralized, I would say it was basically it got us to market quickly. The decentralized versus centralized side of things. So Dharma is a regulated entity, and so for us to touch decentralized type of products is basically non-existent, minus our underlying asset itself. And so as we work with different institutions, again, it becomes for them to be able to invest in these types of products makes it more difficult. So as you have different decentralized products, it's great from, I would say, the individual community being able to have different choices on how can I get this done. As we have different groups that are much larger institutions being involved in the market, again, having that regulatory clarity, being able to invest in certain types of assets, it was fairly easy for us to say, well, great, here we have a standard swap contract that it's under an ISDA agreement through open law, very almost very commonplace, just the underline's different.
And what does that mean? An ISDA agreement through open law?
Sorry. So I'm a derivative head, so I skip a lot of those type of things. So ISDA is the International Swap Dealers Association agreement, and so you can look at this as lots of swap dealers have gotten together and standardized a document that drives this swap agreement. So that ISDA, is I don't know, it's probably, 40, 50, 60 pages. And so that agreement basically is a driver for everybody to start from a common ground. And then obviously the terms are changed. What we've done with Open Law is that Open Law is a group that has been codifying legal agreements. So it's basically taking all of those terms, and then you can have smart contract functionality, i.e., a margin call if price hits here, and it can be driven right off of the contract. And so Aaron Wright, who heads that up, has been fantastic. We've put together a great structure that drives this from an onboarding process and then an ongoing process with what the agreement writes.
And there are other crypto systems that you are partnering with, Filecoin, Figment Networks, and Luca. Can you just briefly describe how you're using those as well?
So what we reference as VSPs, validating service providers. So today we work with Bison Trails, Consensus is Codify, and Figment for that software that actually stakes the ether. Right. So they're the ones that are really managing that process of validating blocks. And we've already even seen, not from those three, but we've already seen slashing events occur because people have been trying to, to validate on the ETH chain, and basically had tried to propose two blocks at the same time. We also we work with Filecoin. Filecoin basically takes the open law agreements, right, and then puts an encrypted hash onto onto their network. And in addition to that, we actually have a swap facility for Filecoin, and it's basically to help encourage miners to be able to borrow Filecoin, because today the rates are astronomically high, and so we basically are trying to help that network to continue growing and not be so expensive. Another partner of ours is Luca. Luca really has been driving a ton of our regulatory reporting side of things, and that's basically, again, as we start to touch all of these different regulatory issues, they've just been key for helping us in navigating that. And I would have to absolutely say that probably the one of the biggest partners that we've leaned on a lot is Balance, our custodian. And I actually think, to my knowledge, they're the only ones in North America that are able to hold the BLS keys, the withdrawal keys in the deposit contract for us. Staking Ether is a little bit more complicated. You have this validator key, you have the withdrawal key, and that withdrawal key obviously isn't going to be touched for the next year and a half to 3 years or so. So they have also been phenomenal in helping with us.
LiquidStake is not registered with the CFTC, nor is it a member of NFA, the self-regulatory organization for the U.S. derivatives industry. How are you able to do this from a lending perspective, from a regulatory perspective?
Sure. So and that's where DARMA Capital issues swaps, right? And so those derivatives are they all come from DARMA Capital. LiquidStake isn't entering into any swaps. They are basically just loan contracts to individuals. So we make sure to I guess call it bifurcate which which is the counterparties and the loan documentation or the swap documentation, and then what we do is we provide these USDC loans in jurisdictions where it doesn't have to be a registered entity.
And how much money has been staked via LiquidStake so far?
So we won't start lending until the 15th. And so currently it's just been DARMA putting Ether in to be a part of the Genesis block. But what we've done is we've allocated $50 million to the lending facility. So that'll be a component both of swap and loan contracts.
All right, great. Well, it's been great having you on Unconfirmed.
This has been great. Thank you.
Don't forget, next up is the weekly news recap. Thanks for tuning in to this week's news recap. First headline, Ethereum 2.0's Beacon Chain is live. On Tuesday at noon UTC, the Ethereum 2.0 Beacon Chain launched after years of anticipation, ushering in the blockchain's next era. The Beacon Chain launch is phase 0 of Ethereum's multi-step upgrade to a more scalable blockchain. There are still many technical hurdles to surpass, including sharding and rollup adoption, before the chain will be fully operational. However, as of press time, there are almost 1 million ETH staked, almost double the number that were required for the launch. If you're wondering about staking's risks and rewards, for staking 1 ETH, validators are currently earning around 0.14 ETH per month, or $8.50, with the amount expected to decrease as the number of participants rises. However, any Ether staked on the chain will be locked up for months and potentially even years. Staking also entails software risks, as well as the possibility that you could lose your initial deposit if you fail to keep up with the network. Despite some suggestions that current DeFi rewards may be a better bet, exchanges are already intending to support Ethereum 2 staking. Coinbase has announced it will support ETH2 staking and trading to eligible jurisdictions starting early next year, while also allowing customers to convert ETH to ETH2 and earn staking rewards. Binance likewise announced an ETH2 staking service that would be live on December 2nd with daily rewards distributed in the form of BETH tokens. Next headline, Bitcoin hits a new all-time high. Bitcoin reached $19,850 on Monday morning, inching past the previous record set in December 2017. Chainalysis attributed the rise to institutional investors purchasing steadily over time, and then taking the money off exchanges to hold. An analysis by Coinmetrics, beginning in November, illustrated that the recent upwards price movements have been occurring mostly during U.S. market hours, further supporting the thesis that institutional investors are the ones pushing the price up. When tracking the Bitcoin price against notable events of institutional interest, such as MicroStrategy's and Square's purchases of Bitcoin, PayPal's integration of Bitcoin, and well-known traditional investors Bill Miller and Stan Druckenmiller expressing confidence in Bitcoin, a clear trend line emerges. Another data point supporting the theory that institutional investor interest is driving the price up is that there is a lack of public interest in Bitcoin compared to late 2017. The amount of Bitcoin-related tweets is far below levels at that time and has been relatively flat for the last 2 years. Media mentions and searches are also at lower levels than during the previous bull run. Neil Ferguson, writing in Bloomberg, cited the pandemic as a catalyst for increased adoption of Bitcoin this year. He noted that the explosion of stimulus dollars underscored Bitcoin's value due to its scarcity. And he said that this was all happening already amidst a shift towards digital payments. He went on to say that the incoming Biden administration should not seek to develop a, quote, Chinese-style digital dollar, but instead, quote, should recognize the benefits of integrating Bitcoin into the U.S. financial system, which, after all, was originally designed to be less centralized and more respectful of individual privacy than the systems of less free societies. Metrics show Bitcoin and Ethereum activity is heating up. Online metrics are showing an increase in activity on the Bitcoin and Ethereum networks. The block's director of research, Larry Cermak, posted a comprehensive data summary to Twitter, showing, quote, almost everything we track is reaching all-time highs. Total on-chain volume increased to 51.5% to a new yearly high of $204 billion in November, with miner revenue growing 48% over the previous month for Bitcoin and 22% for Ethereum. Stablecoins, in particular, have more than tripled in 2020, with Cermak citing DeFi and Tether collateralized derivatives as main factors. A survey by Blockchain Capital also shows increasing awareness and adoption among the general public. More than 1 in 3 Americans interviewed said they're likely to buy Bitcoin in the next 5 years, and 41% of Americans found it likely that most people will be using Bitcoin in the next 10 years. Next headline, U.S. congressional bill would require bank charters for stablecoin issuers. In the U.S., Congress has presented a bill that would require stablecoin issuers to secure bank charters and regulatory approval before issuing any stablecoins. The bill is designed to protect individuals, according to Representative Rashida Tlaib, who said, quote, preventing cryptocurrency providers from repeating the crimes against low and moderate income residents of color traditional big banks have is critically important. Circle co-founder and CEO Jeremy Allaire responded to the news on Twitter, saying, quote, forcing crypto, fintech, and blockchain companies into the enormous regulatory burdens of Federal Reserve and FDIC regulation and supervision is inconsistent with the goals of supporting innovation in the fair and inclusive delivery of payments that comes from stablecoins. Next headline, Visa partners with Circle Internet Financial to connect to USDC. Next year, Visa's card network of 60 million merchants will be connected to stablecoin USDC. Visa will be the first corporate card to allow businesses to spend a balance of USDC. Visa does not plan to custody the stablecoin at this time, although effective immediately, Circle will begin working with Visa to integrate USDC software with its platforms. According to Visa head of crypto, Kui Sheffield, quote, we continue to think of Visa as a network of networks. Blockchain networks and stablecoins like USDC are just additional networks. So we think that there's a significant value that Visa can provide to our clients, enabling them to access them and enabling them to spend at our merchants. Next headline, Crypto News Roundup. More than $4 billion worth of cryptocurrency, including $3.8 billion of BTC, was seized by Chinese police during a crackdown on the Plus token Ponzi scheme, with a Chinese court saying that the seized crypto, quote, will be processed pursuant to laws and forfeited to the national treasury. In collaboration with crypto startup Luca, the S&P Dow Jones Indices plans to launch 2 index products, which will enable asset management firms to build their own crypto-based investment products. The Libra Association announced the adoption of a new name, Diem, as well as several executive appointments ahead of its eventual launch. After its chief executives were charged with violations of the Bank Secrecy Act by the Department of Justice, 100X Group, which runs BitMEX, appointed Alexander Hopner as its chief executive officer. Hopner was formerly CEO of Börse Stuttgart and EUWAX. Time for fun bits. A strong crypto showing in Forbes 30 Under 30 2021 list. Forbes published its annual 30 Under 30 list celebrating young entrepreneurs. Several blockchain and crypto stars made the cut in the finance and venture capital categories. Among the crypto heavyweights on this year's list were Volt Capital's Suna Amaz, a previous guest on Unchained, FTX co-founder Sam Bankman-Fried, another previous guest, Augur co-founder Joey Krug, another previous guest, CoinList co-founder Brian Tubergen, and Bitcoin core developer Amity Udawar, among others. You can also read an in-depth write-up on the crypto-centric names on the list at Decrypt. All right, well, thanks for tuning in. To learn more about James, LiquidStake, and DARMA Capital, be sure to check out the links in the show notes of your podcast player. Don't forget, we are now on YouTube. Subscribe to the Unchained Podcast YouTube channel today. Unconfirmed is produced by me, Laura Shin, with help from Anthony Yoon, Daniel Ness, Bossy Baker, Shashank, and the team at CLK Transcription. Thanks for listening.